Questions?
With the tax templates in corporate, Mr. Goodis, CEO.
Thank you, Mr. Chair, and members of the committee for time to speak about opportunities in Canadian taxation in advance of the 2020 budget. I'd also like to congratulate new members of the committee. I'm excited and hopeful for all the things you can do for Canada. My expertise is Canadian income tax. For nearly a decade, my software company has been building advanced algorithms for tax planning and tax compliance, specializing in the integration between individuals and corporations. In that time, I've computed countless tax outcomes for taxpayers in all jurisdictions and all income levels. Similar to Mr. Ball's recommendation, I suggest the Government of Canada undertake a detailed review of the tax system with the intention to introduce thoughtful tax reform. There are many elements within the tax system that warrant discussion, but I'd like to share two of those for your attention today. The first is the effective tax rate on income earned by individuals is often drastically higher than the intended tax rate. And the second is the complexity of the current TOSI legislation, which presents ongoing challenges to all concerned parties. The behavioral response of taxpayers to varying marginal tax rates is an often discussed topic. In Canada, the top personal income tax rate on ordinary income ranges between 44.5% and 54%. We intuitively expect that these are the maximum rates that will be paid on income. We also expect that they'll be paid by those earning relatively high amounts of income. For a comprehensive review, we must also include the impact of income-tested government policies. Taxpayers with average incomes can face high effective tax rates through a combination of progressive tax rates and, as are often overlooked in basic calculations, material differences in various benefits and payroll amounts. After all, $1 lost to taxes and $1 of benefits lost is directly equal. The example I'm using today is a spousal couple living in Ontario with 2 young children. The parents have identical employment income and they deduct allowable childcare. This is a completely ordinary scenario, not some exotic fabrication. I tested the net cash outcome of their earning an additional $1,000 of employment income, starting at $25,000 of employment income for each parent. The lowest effective marginal tax rate was 44.19% in taxes, payroll costs, and reduced benefits. And the worst result was 93.09% in taxes, payroll costs, and reduced benefits. This 93% tax rate arose at $37,000 of average income. Many would be surprised to learn of a rate so high, but be more surprised at the income level to which it applies. Considering effective rates, peaks and valleys stemming from overlapping tax rates, credits, and payments, testing $1,000 additions might yield some unusual figures. To confirm the general results, I repeated the exercise testing it at effective marginal rates on earning an additional $5,000 of income. While normalizing the extremes, a family is subject to a 73.44% marginal rate at only $35,000 of average income. So if they should earn a bonus or work some extra shifts, is this really the intended outcome? So continuing with this $35,000 of income per parent, the effective tax rate on $1,000 and $5,000 was approximately 42% to 53% across all provinces and territories. So these take-home amounts are relatively aligned with the top federal and provincial tax rates of each province. This is to say that on a cash basis, someone earning $35,000 will experience approximately the same effective tax rates as someone earning $300,000. Changing details such as self-employment income versus employment income or increasing the income of one parent at the expense of the other normally leads to higher overall tax rates, even when the overall income earned remains the same. So let's look at another example, considering a CCPC in Nova Scotia with one shareholder that earns interest income. This interest is taxed in the corporation, then paid out as dividends to the shareholder where it's taxed again. Once all corporate and personal taxes are paid, the total tax paid at 2020 top rates is 61.98%. That's compared to the highest marginal rate of 54%. Other provinces also near 60% integrated tax rates in this scenario. And these types of incomes are not limited to individuals. An example would be a CCPC facing the clawback of the small business deduction, which will face temporary cash impacts ranging from 117% to 144% of income, depending on the province. There are more examples, but these here may justify a closer look at Canada's tax system to ensure that legislation achieves the intended results. There are rational behavioral responses to effective marginal rates, whether to invest, enter the workforce, take an extra shift, or which country to start a business or seek employment. The government could take steps to review clawback rates or legislate maximum clawbacks. The government could also review integrated tax rates to ensure reasonable corporate and personal tax integration. The government could also take a look at tax rates of other countries, specifically the United States, to ensure our tax system is competitive for businesses and taxpayers. I'd now like to discuss the tax on split income rules, commonly known as TOSI. TOSI rules continue to represent a challenge for businesses, shareholders, and their advisors. Since their introduction, the topic has become a staple at Canadian tax conferences across the country due to its complexity and scope. It impacts every CCPC and their shareholders. Advising on TOSI should only be done by advisors who specialize in this area, but due to its wide impact on small businesses and the cost to hire specialists, it's common for more direct approaches to be taken while decisions are made. I'll share with you a common scenario that advisors are facing, which I hope will help the committee understand the results of the legislation. Let's assume that Spouse A and Spouse B operate a trucking business that each is actively involved in, and they are not subject to TOSI due to their active involvement. Due to a medical emergency of Spouse A, they sell the trucking business, Spouse A retires, and Spouse B actively manages the investments inside the same corporation. Since Spouse A is not actively managing the investment business, which was funded by Spouse A's and Spouse B's direct efforts in the trucking business, Spouse A could be subject to TOSI at the highest personal tax rate on subsequent investment returns. This is one of many unintended consequences that the tax community has seen, and there have been many submissions to CRA and Finance identifying a multitude of other scenarios. I'll also share that in a recent article by Stan Shadrin, Manu Kakar, and Alex Ghani, it was shown how the TOSI rules can create double taxation scenarios, subjecting individual taxpayers in Ontario to a tax rate of 107%. Again, as I spoke to earlier, we find presumably unintended tax consequences which lead to these exorbitant rates. So if there is a willingness to reopen the discussion about TOSI, I would recommend an alternative approach to complex guidance. To achieve the perceived key outcomes as outlined by Finance, many of Canada's top tax experts have suggested raising the kiddie tax from 18 to 24 in lieu of the current legislation. This change would significantly simplify the tax system and reduce the administrative costs, legal challenges, and burden of CRA and the taxpayers. So if there is an appetite by the committee and others in Parliament to explore comprehensive tax reform to address these issues, along with several others such as Canada's SHRED program, stock option deductions, and the small business deduction, along with a few things that I heard Mr. Ball speak to, I would be happy to provide relevant information and viewpoints to explore these opportunities for improvement. Thank you for listening to my ideas, and I'm happy to answer your questions afterwards. Thank you.
Thank you very much.